As always, just a quick disclaimer that this presentation is for information purposes only. We're very proud of the education that we have on our webinars. But again, that's all it is. It's just education. Please don't take any of this information and act on it. If you need any help, seek the appropriate person or contact us. We'll gladly help you out. Let's get started. So I just want to mention a couple of things that this is not the only webinar that we do. For those of you that are here for the first time, we have webinars on diversification of a portfolio, financial planning, structured income, a lot of other webinars such as alternative investments, even estate planning, wills, trust, and legacy. So I encourage you to ask the person that invited you here to send you links of some of these webinars that we've done in the past. So today we're going to cover very briefly who we are, but the bulk of this presentation, as always, is education. We're going to talk about the mechanics of layered investing. I know you may have seen what layered investing is. Today we're going to talk about how it actually works, how we choose layers, how the decisions made, and it's a great presentation. I actually learned a lot putting this together with Rick Watson, who's going to be our featured speaker, and of course we have a Q&A session. Just a quick introduction to us. We do have a couple of physical offices in Los Angeles and Roseville, California. We started in 2008, and we're a specialty investment group. We have financial advisors, CFP, CLUs, and a very experienced support staff. And we have a dedicated financial planning team, which I cannot emphasize are the backbone of everything that we do for our clients. There are two groups of people on this presentation. They're individuals. These are people that are interested in total asset protection. I want to welcome you. Stick around to see what PPA has to offer. And those of you that are advisors that are here looking at this presentation, this is typically how we do our introductions to people that don't know what Protection Point Advisors is. And I know that you understand we recruit and train financial advisors from around the country. I want to make sure that if you're an advisor, you stick around and ask any questions that you've got. We'll gladly answer those for you as well. I love this slide because our team continues to grow, and pretty soon we're going to run out of space here and going to have to make everybody's picture smaller and smaller. But I also want to take a second and mention the fact that we have a great team that works with us throughout the country, that works with our clients as far as advisors and agents in this industry. So we have a lot of reach when it comes to being able to help clients throughout the country. So what is the PPA business philosophy? At Protection Point, we realize it's a relationship business. So I want everybody to sit back who's new. Nobody's going to end up at the end of this presentation and jump up and ask you to make a decision. We understand that you have to take the time and learn what a business is all about before you make a decision. We truly do education and financial literacy and step back. That's what we do. We educate and step back when it comes to anyone looking at us. And we always believe in doing the right thing. And that foundation has been the reason why the average client has been with us for 15 years, and they continue to bring other clients to the table because of what we've built. But if you ask most clients why they're here, you might think that they're going to say they're here because of our investment management. We do a great job, but the truth is we do a lot more than that. We help clients with financial planning, retirement planning, estate planning, tax planning, financial literacy, college planning, insurance planning, and of course, alternative assets. But the key to the financial success that our clients have is making sure that all of these elements work together to create total asset protection. And that's what 3D Asset Care is all about. It truly is the backbone of what we do here when it comes to the financial universe of our clients. So today we want to focus a little bit on that investment management side of it. And I just want to talk about something before I bring Rick online here, because when it comes to financial planning timeline, everybody's familiar with working years and retirement years, but very few people talk about the fact that the third phase of it is called a transition or transfer of asset control. Many of us don't realize that at the end of the day, we're doing what we're doing because we want to pass our assets, or we want to pass a legacy to a family. And it's important to work with a firm that's been on both sides of that financial planning timeline. And I can't think of anyone more qualified to take us through the rest of this presentation, because he truly has been on both sides of that in helping clients, than Rick Watson. He's one of the founders of Protection Point Advisors. With 30 years of experience in the financial industry, he's built a firm with laser focus on results. And today he teaches advisors about advanced portfolio strategies. He's got all the qualifications in the world, but I'm going to turn it over to him to share a bit about his background and what he's going to talk to us today about when it comes to layered investment.
Thanks, Patrick, for that. So let me just tell you a little bit about who I am, where I come from. I grew up in finance. My dad was an upper yuckety yuck for a major insurance company and later head of annuities for the West Coast for that company. And I worked for that company for 18 years. And the problem is that I was wrestling with commissions and sales quotas and how it polluted the relationship with the client. And so at some point, I resolved that I needed to do something different. And I remember telling my dad it would cost me my pension to leave, but it was what I was going to do. So when we went out on our own, we resolved to be something different. And I think the financial industry needs to change. I love pulling back that curtain. We're a firm made up of advisors who wanted to do it better, and we want to be a good home to them. So let me tell you a little bit about where we're going with this. So first, we're going to talk about volatility. We're also going to talk about, as Patrick said, the how portfolios are built with layered investment management. But let's start at the beginning of what does volatility mean for you? Well, for most people, what it means is an emotional roller coaster. And we all like to think that we are not affected by this, but what ends up happening more often than not is bad investment choices. And those bad investment choices lead to something called sequence of return risk. I'm going to mention this a little bit later, but it's a major retirement trap. We have a whole webinar based on this, and if it's something that you'll want to know more about, you're going to see how this is going to feed into it. I would just tell you in your little question box, you could put sequence of return risk, and we could send you a recorded version of that program. All right, so why should investors fear traditional static portfolios? Well, for one, they really lack the sophisticated solutions that are out there today. Secondly, they're all based on this cookie cutter investment systems. So if you had tens of millions of dollars, you're not going to rely on these traditional static portfolios. You're going to be thinking, I want something better than that. And our whole point is, why shouldn't you want that if you don't have $10 million? So the reason that these static portfolios get created, these sort of traditional, is because advisors and agents are hired with very little training. Remember, I was going to talk a little bit about pulling back the curtain. Well, this is the why it's happening. This has led to this cookie cutter investment approach. See, what happens is they sell what the house tells them to sell. And then they tend to be restricted to what the house has to offer, which means they don't even have that stuff on the shelf if there was more that you might want. And most firms have to use these really simple and fast systems to train because they're cycling through so many advisors, the average advisor only surviving for about 5 years. So let me give you an example of this. The clients are given a simple risk questionnaire, and it gives you a number from 1 to 5. They're put into traditional pre-mixed portfolios based on that risk assessment. For example, a client with a risk of 5 might have 80% bonds and 20% stocks, and a client with a risk of 1 might have 20% bonds and 80% stocks. This is okay as sort of a beginning step, but that's, for most firms, that's exactly where it ends. It's a formula-based process, not a customized approach. And what they do is they use this concept called modern portfolio theory, and it's used to create these static one-layered solutions. So let's talk a little bit about what we mean when we say modern portfolio theory. Modern portfolio theory, or MPT, well, first let's just define it. It's the idea of combining different types of assets together or investments to reduce risk. So for example, here's stocks, bonds, and gold. I might invest, I'm afraid stocks might go down, so I have some gold. And you mix your portfolio with lots of these things so the risk of one offsets the risk of another. It's supposed to help reduce risk through diversification, and it does work. But it does have downsides, so we're going to get to that in a minute. So traditional static single-layered portfolios based on modern portfolio theory, the problem is that the idea is 70 years old. and it's the general approach used by most advisors. Why is that? We just talked about it. It's because it's easy to teach. The only way to increase your returns is to take more risk. That is a problem. So we're going to talk about that. Um, so the inventor of MPT, Harry Markowitz, added layer after he came up with the idea. He said, really, there are more layers to this, and that's what we're talking about. We're going to talk about more here. There's nothing wrong with modern portfolio theory, but you should understand its downsides, and we believe it should not be your only layer of investing. So traditional portfolios, they start out kind of like this: a layer of cash, a layer of bonds, and a layer of stocks. And then they assign a certain set of percentages to you based on that questionnaire that you might have filled out. And then they stick with that for the long term. The problem with it is it doesn't get out of the way of market downturns. So this diversification that you're looking for really helps you during good times, but it doesn't really help you during bad times because everything tends to move together. We'll show you that in a minute. So it tends to ride the highs and the lows of markets and can create these massive drawdowns, which can devastate a portfolio, particularly during the withdrawal period. And as I mentioned to you guys earlier, that's all part of a webinar that we have on the disadvantages of modern portfolio theory, sequence of return risk. Okay, it's a major thing. I'm curious, how many people have heard a clear explanation of sequence of return risk by their advisor? See, we talk about this all the time, but I find that most advisors never bring these things up. So the questions you should be thinking about is, how does it affect your investment and retirement assets? When should you worry most about sequence of return risk? And how do you protect yourself? So sequence of return risk is the risk of returns happening in a specific order that could be really damaging. So we are here to talk about layered investment management. Let's focus here. It's a proprietary system developed after 30 years of investment research and success. It's a system of investment and protection point fuses to create a long-term winning formula designed to protect against sequence of return risk as well as other retirement asset traps. So we start with the same basic layers, right? This is the same things we showed before. And there's a layer of static. We don't think it's a bad thing. We just think it's one layer. But we also add layers of active management. And where that line should be, well, that depends on the individual. And that's where there's a lot of customization that occurs in a portfolio. But for right now, let's focus on the active management piece. So here's a number of layers of active management. We have dynamic asset allocation, and defensive strategies. We've got structured income and then the traditional stuff that we've talked about before. And what we would do is introduce this concept of protection point fuses. These fuses pop to move money from one area to another to protect the portfolio from downside risk. We'll talk about what I mean by that in a second. Let's look at an actual static modern portfolio theory portfolio and see what it does through a market correction. Now, this is the green is stock, the blue is bonds, the magenta is alternatives, and then we have cash. And you can see that the market dips in a dramatic way, and all that we have is this portfolio never changes. That's the problem, is it doesn't try to steer out of the way of ugliness. So let me show you, in contrast, we'll show you a portfolio here, same sort of thing, but this is during that same time period, and you can see how we dropped the stock exposure from 75% down to 10% to protect the investor. So let's look at how we create these layers. We start where most portfolios end. We have the basic layer of stocks, bonds, and cash, as I mentioned earlier, but we add other layers like alternatives and styles of investing like momentum or dividend. These are all different approaches than just modern portfolio theory, and so we want to layer one strategy on top of another. The protection point fuses that I mentioned adjust to protect your investment from major market corrections. They protect you from those market lows, and a great example is what we saw last year during COVID, when our average return, we were down, but about half as much or less than half as much as the market generally. So one of the questions that comes up a lot is, are we market timing or are we timing the markets? The answer is no. We're taking chips off the table in a methodical way. And we have these fuses that pop in stages based on market conditions. A portion of the portfolio goes to a protective layer. As the market conditions change, the money flows back in, and then the fuses get reset. Let me show you an actual example, and I'm going to use one of Patrick's clients. This is a snapshot we took from last year. What I want you to see is this is where the first fuse kicked in late February. Okay, I think COVID started to become kind of noticeable around the 20th of February, and then markets started to get hit, and that's where we started to make corrections. And you can see that the first fuse hit there. Then we have another fuse, and another fuse that resets, allows us to go back up. Oh, no, that's not good. Resets again. And then gets us back into the markets. Let me show you how, on a practical standpoint, this worked. We took somebody from 54% stock exposure down to 3% stock exposure, leaving 60% of their portfolio in cash. And that cash has some advantages. What can we do with that cash? Well, one thing we can do is we can use it when the market's been beaten down. And that's part of the reason this whole thing works so well. So fuses pop during volatility. These triggers adjust during major market corrections. And there are three main inputs to how we build these fuses. One is institutional information. What are the institutions doing? Artificial intelligence information. So we have two different artificial intelligence systems that calculate risk in the market, and they'd say, the risk is starting to go up. And then a human element, and that's where we use technical analysis for real-time data to double-check these other decisions. So let me show you how that works. As Patrick said, we recruit and train advisors nationally. And I was just showing advisors this slide yesterday. And our AI system wanted to go to cash, but our technical analysis said, no, not yet. And if you look right here, you'll see where the computer wanted to go to cash, and for good reason. It broke the trend line. On the other hand, we could see a support line, which is that sort of horizontal line, and it bounced right off of that and came back up. So we use these three systems to basically make decisions. So the power of investment, layered investment management. So what's the goal here? Well, the goal is to lose less in market downturns than everybody else, so that we don't have to make up as much, and then we lose less in the next market downturn, and so on. The average investor is going to experience between 3 and 4 of these major market downturns along the way. We just want to use these fuses to create a significant difference over time. Does it work? Well, here's an example of one of our systems, Merlin. And what we did is we just tracked Merlin over time versus the S&P. Now, by the way, it's interesting. Merlin was one of our best performing portfolios last year, and so far this year, it's our second worst performing portfolio. It does have bad periods, but the difference over time can be significant. Again, this back tested returns, right? No guaranteed that the future is going to work like that, and so on. All right, so with this, I'm going to pass it back to Patrick, and he's going to do a short summary of layered investment management for us. Patrick?
Thanks for that, Rick. Again, I see a couple of questions here. I will definitely get those questions answered, I promise. So just to summarize before we wrap up here, so these triggers, these fuses adjust. This is not something that is preset, that we will adjust them based on what's going on in the markets to protect the investments from major market corrections. And it's a strategy which attempts to protect from falling markets. As Rick mentioned, everybody's question last year at this time was, does it work? And sure enough, I can't think of a better time than last year, where the markets dropped by 33% in 4 weeks, and our system did everything that it was supposed to do. But one thing I really want to mention is that investment management, if you remember when I mentioned, is just one element. The other elements that you need is making sure that everything in your financial universe is working together. And that's part of our 3D asset care. So what we do is we have live online client education series. If you're a client with us, with a member network of CPAs, tax attorneys, financial planners, estate planning attorneys, college planners, all of them presenting every month to our clients live so that our clients can ask questions and certainly avoid any of the traps that are in that industry. But the important thing is making sure it all works together. We're expanding this into real estate sales, for example. If you have any questions about that, we have experts talking mortgage and refinancing. And recently, through the launch of the National Referral Network and the member partners we have around the country, we're able to provide a lot more services to clients as well. So it's just bringing all of their financials under one roof and making sure it works together. So, to make sure you reach your financial destination, I suggest that you get a no cost 4 step review by our experienced team. I'm going to run you through what that means really quickly. Step one is a comprehensive risk assessment. This is about a 20-minute meeting. We're respectful of your time. This is to help you understand how you think about money. Are you the type that goes to Las Vegas with your 401k, or are you the type that puts it in a mattress? And step number two is a comprehensive stress test. We actually take a look at your existing portfolio and we compare it to your risk test and give you some feedback and show you whether you're on track with your thinking or not. And it's a great way to really assess where your portfolio is headed and what it can do. So, for example, is your portfolio poised to drop again by 48% based on its current investments if you have another 2008 event? The third step, which is the most critical step, is a financial plan. This is the express plan. You meet with our financial planning department. They review the clear path report with you. This is really clearing the fog of what the future looks like. It's a year by year review of what your investments, your funds, your expenses should look like, and it compares it to potential market correction. So it doesn't just stop at a average 5% rate of return. We can actually put in market corrections and really put the plan to the test and see if it's going to work through the potential market downturns that we would have. And then only then we would suggest some alternatives and some potential solutions once we've got the risk analysis and the financial plan and we really know where your headspace is at. We'll provide some solutions. These are all meetings are about 15 to 20 minutes. Sometimes they go to about 30 minutes if you have questions. It's a great way to simplify a very difficult process and make sure clients understand exactly what their needs are and what their solutions are. So as we wrap up, there's usually two groups of people. Group A say, this is not for me. I respect the time that you spent with us. Maybe you can forward it to someone that you care about. Group B are people that say, you know what, I'd like more information. I want to find out about my detailed risk analysis, and I do want my portfolio stress tested or get a proper financial plan. If you're interested in any of that, please make sure you get back to the advisor that invited you to this presentation, or feel free to leave your information in the question box and we will certainly get back to you and answer any questions that you may have. So with that, I'm going to thank everyone for joining us today. I want to thank Rick for taking the time in the afternoon to be with us. This will be recorded, so if you want to share this with someone, please let the advisor know and we'll make sure we get a recording to you as well so you can share this with anyone you care about. So with that, I'm going to thank everyone for being here today and we look forward to speaking to you on our next webinar. Have a great day, everyone. Thanks, Rick.